Hi everyone, hope you're doing well on this Saturday. I thought of making another video on a very important subject of capital allocation, and we will cover capital allocation from both the perspective of businesses and investors. So first I want to talk about what is capital allocation, and it's important to understand that we need to take a very holistic view of capital allocation. Anything which is limited is capital and it needs to be allocated properly. With that definition, money is just one type of capital. Perhaps the most important type of capital is time for humans as well as for companies. And another most important capital in personal life is emotional capital or relationship capital, and the kind of places we allocate it to. So, coming back to the subject of capital allocation, first let's talk about businesses and why capital allocation is important for a business. So what I can definitely say is that everybody should consider reading this book called Capital Returns by Edward Chancellor. It essentially talks about the different cycles in a particular industry and why those cycles occur. And specifically what happens is, imagine that you're in a place where there is very high demand. What happens is that most managers would extrapolate that demand into the future, do huge capital investments, and because of those huge capital investments, there is excess supply. And because of that excess supply, and because this kind of demand growth is not secular, it often has like ups and downs, right? Because of that, the excess supply creates the capital cycle, and that is when the abnormal ROCE or abnormal profitability goes down, and that is when the cycle sort of hits the peak, and then basically capital investment stops, and eventually the capital comes back to a phase where more capital can be deployed, right? This is the general capital cycle. You'll find it in almost all industries. The two very famous ones are airline and semiconductor, have very well defined capital cycles, as well as in steel industry. Every industry has a capital cycle. Now why are we talking about this in capital allocation? It's important to understand that any particular business manager is trying to balance their company on a very fine two-axis system. So this is profitability. Let's say this is ROCE, and this is growth, right? These are two axes, this being positive and this being negative, right? The ideal business and the ideal capital allocation would take businesses here and here, right? Imagine this is something like 20% growth, 20% ROCE. You can also go to 30, if you're a very, very good business. Most of the managers are trying to bring their businesses there. Now, what really dictates whether a business reaches in the top quadrant and on the x equal to y axis towards the top is really capital allocation, right? What kind of businesses do a particular company want to get into? What kind of products, what kind of value addition? These are different kinds of choices and different kind of trade-offs which companies have to make. Do I want to make a product for everybody? Do I want to be a Maruti that will make for the entry-level cars a Maruti 800? Or do I want to be a Tesla? I'll make $50,000 cars that everybody cannot afford, but it will be like a luxurious kind of a item. And the reason that companies are forced to make these choices, and this is the essence of capital allocation, the reason companies have to make these choices is because each type of product requires a value chain and the set of activities which are performed inside the company, which are specialized for that particular product and specialized for that particular kind of capital allocation. So it is very, very rare to find, or very difficult to find, companies which can do everything, right? If you say that there is a company that can make a Maruti 800 and it can make a two-wheeler and it can make a Tesla and it can make a BMW, typically they don't exist, or if they do, then those would be rare companies essentially. So just to also bring home the point that capital allocation should not be just looked at from the point of view of the CEO deciding or the MD deciding where should I do a capex or that kind of thing. Capital allocation is the DNA of a company, right? It's not just the CEO, it's every single employee and what they choose to do with their time. If you look at most good companies, including companies that I'm familiar with, meaning in a professional capacity, what I've seen is that there is a mindset of, let's try small experiments and do many such small experiments and let's see what really works, and sort of a fail fast attitude, right? This is also something which Jeff Bezos talks about a lot, that he wants to try like 1,000 different kind of experiments, like small different experiments, and then whatever succeeds or becomes large, he will deploy even more capital. You can think of it like a pyramiding kind of a scheme where you are trying many different things in terms of capital allocation, different experiments. You might try Alexa, you might try AWS, but think of it this way, that Alexa and AWS are 2 out of maybe 1,000 ideas that Jeff Bezos and team would have tried, right? So now, having talked about the importance of escaping the capital cycle through good capital allocation that can balance between ROCE and growth by creating differentiation inside the company, let's take a couple of examples. So just to be very clear, anything I say in this video is not a buy, sell, etc. recommendation. I'm only sharing my experiences of studying these companies. So first company is by the name of RACL Geartech. So over time, as we have listened to the management in the con calls and understood what the company does, few very interesting things have stood out to us. For example, the company says that we only do capex after we have firm committed orders from the client, right? So RACL, firm orders, right? Second important capital allocation decision, only niche, high value markets, right? Third decision, backward integration to expand value addition and strength of supply chain, right? So if you think about it, all of these are very good capital allocation decisions. The first thing being, they only want to do a capex if the company has confirmed orders from clients. This ensures that they're not just putting up capacity with the hope that someone will come in and then they will be able to sell it, right? That's really good capital allocation. Second thing, they have made sure that only they go into high niche value products. This ensures that the competitive intensity is low and they are high on the ROCE growth curve, right? Because basically you want to be able to be a lowest cost producer so that you have economies of scale in your favor, and so that you are able to provide these gears and chassis components at very competitive prices. But also you want to be in value added so that the competitive intensity is low, so that the client cares more about the quality and not just about the price, and that's why you're able to make 20% ROE across cycle, which is rare for an auto ancillary. The third thing being backward integration. So recently we've also gotten to know they do their own forging in-house and so on and so forth, and all of these basically ensure that their value addition is high, and now they want to do sort of machining and finishing also of those components. All of that ensures that there is high value addition, and through this backward integration, the value addition being high means that the ROCE is high, and again they are able to do very good capital allocation. Let's take a second example here, and then we'll come to another interesting aspect of capital allocation. The second example is Shivalik. Shivalik Bimetals. Now, every company would do capital allocation in a different way, and its sort of unique beauty would stand out in different ways. With RACL, it was about making those choices or trade-offs between where you want to be present, where you don't want to be present. With Shivalik, the thing is, they used to make these cathode ray tube monitors, and those monitors, I guess they could see, are going to become obsolete, right? With the advent of LCDs, LEDs and so forth. The interesting capital allocation they do is they do a lot of R&D, fundamental research, trying to see how their metal joining skills can create new products that the market can appreciate, value, and basically where they can do something unique, right? So through these R&D efforts, they were able to make this ultra low ohmic, micro ohmic shunt resistors, which are used inside BMSs to measure current, right? But the thing I want people to appreciate is this is the pure beauty of capital allocation, right? 1,000 small experiments, non-linear success. One thing succeeds, you immediately create thousands of crores worth of value, right? So that's the beauty of a small experiment kind of capital allocation. And this is a beautiful thing to see that like this thing works not just in software, even though it comes from Amazon and is practiced across the industry in good companies, but it also works for manufacturing companies. The second very good thing, even for Shivalik, the kind of capex that they are doing, what they had discussed in the investor meet recently is that they have firm commitments for a large percentage of the capacity that they're putting up, right? So the fact that they have something similar to RSCL where basically they have these order visibility and the capex is done after that, that also ensures that the ROCE would be somewhere high, right? The third thing, of course, is as you're thinking about applications, you're trying to create something that is where the value is migrating. That's how you're able to get high growth, right? The fact that you're able to make a BMS shunt and then that goes into EV, that's where some of the high growth comes from. So now we are sort of done with a couple of different examples. Let's now sort of discuss the second type of capital allocation. So investors, right? We as financial investors also do capital allocation. Why is this important for us? It has to be understood very well that every single company that we study does not deserve the same amount of commitment from us in terms of our financial or monetary capital, right? How do we decide what kind of commitment to give to a company? Essentially depends on our capital allocation framework. So I want to share my capital allocation framework through 3 examples so that I'm able to very clearly illustrate what I'm talking about. The first thing is RSCL, right? Now the thing to understand about RSCL and the way it happened to me is I was very, very lucky or some kind of serendipity that I ended up reading about it, and in June 20, which was basically like near the COVID bottom, and there this company was available for 5x PE, right? This is the kind of asymmetric risk reward which made me take a decent sized capital allocation despite the fact that the company is a micro cap, and despite the fact that we were in the middle of a global pandemic, and despite the fact that even I personally felt I may not actually know too much. But what has to be appreciated is the risk reward in this situation, right? Any company at 5x is good capital allocation. Great company at 5x PE is great capital allocation, right? Shivalik. So the interesting thing that happened with Shivalik is I did find the thread near the COVID bottom, but for some reason I was biased in some way. I think when I read the thread, I couldn't understand it. Now, rather than going deeper into it, I just left it alone, right? I just didn't read it more. I didn't study more. I didn't research more. I didn't actually try to find out what the hell is Shivalik doing, right? Because the thread even at that point was not that deep in terms of the research. So I actually missed it at that point. But the important thing is not to compound our errors of omission with another error of omission. So when I ended up revisiting it sometime in 22, that's when I could truly understand the beauty of Shivalik's moat, the fact that they are the lowest cost producer, the fact that they are perhaps the largest producer, they are the cheapest producer, the fact that Shivalik maybe has 10 to 15% global market share, both in shunts and bimetals, the fact that they have a very clear and competitive right to win because of the fact that they do their own capex, they have 5 to 10x lower capital costs, the fact that they have developed the processes in-house, the fact that they have done configuration and customization in-house, all of these things, testing, tooling, all of these ensure that they have a right to win, right? All of this made me take a decent sized bet even at 28 times earnings, right? So it was a 28 times earnings, but I could appreciate the moat that Shivalik has. I could see that at least for a few quarters, the growth is going to come because they had consolidated one of their partially owned subsidiary to be a wholly owned subsidiary, and because of that, they would get a tremendous jump in EPS, right? I could see all those things, and so I was able to take again a decent sized allocation. And at the point where I took the allocation, it was my largest position, right? It has now become a bit lower because other positions have appreciated more since that time, and basically as the portfolio grows, the amount of capital you deploy in every incremental position also becomes larger. But the point is, Shivalik was another such case of like how could I take a large position, right? So in the case of RECL, it was the pure undervaluation, raw absolute undervaluation. In the case of Shivalik, it was the quality of moats which I could understand and appreciate, and the growth runway as well. So if I were to again go back to that profitability growth, it consistently features here. Depending on the industry tailwinds and market conditions, it might be either here, which is like let's say 2020, or if the market conditions are great, then it might be at 30. But I mean, it's somewhere in the middle of this, right? We don't know which one, but it's definitely in that band. The third one I want to talk about is, recently I was studying a IP product company, and what I could figure out there is that there was a change in the management. The fact that market's view was a old one, it hadn't been updated, and you had a company which was guiding for and executing 25 to 30% growth available at single digit PE, 9 to 10 PE, right? Again, it's a very, very mispriced opportunity which has to be understood and evaluated in the point in time where you're operating, right? Because markets are very fast in discounting information. We have to be very diligent in doing as much due diligence as we can, burning the night oil as much as possible, right? That is how I was able to take again a very large position and allocation, and it is my largest holding now. And because there were some corporate governance concerns, so I haven't discussed the name. So that's how it is. So the fourth thing, last thing, I know it's a very long video, sorry for that. Last thing I want to discuss is microcaps. So, interestingly, I was running some screeners recently for companies which have, let's say, 50% sales growth in last 3 years, 40% growth last year, 60% ROE last 3 years, right? These are companies which are sort of hyper scaling, right? 50%, 40% kind of sales growth, profit growth is even higher, 60% ROE, so this is actually profitable growth, right? When I do these kind of screens, I could find a few different companies. I studied them. Some of them I have bought already. Just to say, like the screen I just ran after buying, I mean, this is not a screen which I first ran. I first bought the companies, then I realized that there is a commonality here and I need to sort of create a screen around this. But the point being, when I read through and I could find some conviction to buy these companies, the question is of capital allocation and of position sizing, right? So I could only take like a 5% position. Typically I have like 12 to 13 positions or so. So basically you can imagine that 5% is not a very high weightage. But the reason I only took a 5% position is because the downside is high. I don't want to concentrate too much in these kind of small companies. These are typically companies growing at 50% are typically small companies. I don't want to concentrate too much, so I took like a 5% position, and that was like the last example for capital allocation for investors. Thank you everyone and have a good weekend. Bye.